copyright of this video belongs to CA Campus. Offenders will be prosecuted.
Welcome to our discussion on example 7 on our intragroup examples. In this example, we have a subsidiary that sells a depreciable asset to our parent. Therefore, immediately we need to identify that this will have an effect on our analysis of owner's equity that we use for calculation purposes only. Now let's read through the information provided. The parent is Auto Trading Limited, subsidiary Motor Limited, acquisition date 1 August 20.12 and year end 31 December 20.13. Now on 1 November 20.12, Motors Limited sold a previously owned vehicle to Auto Trading Limited for an amount of 62,000. The vehicle will be used for company purposes by the financial manager of Auto Trading Limited. Therefore, we know, guys, we can recognize this as PPE and there will be depreciation that we need to account for. Motors Limited charges a gross profit percentage of 30% on sales. Now, guys, why is this important to us? We need to calculate the unrealized profit that is still included in the assets carrying amount. Therefore, guys, our cost of sales will be 70%, our gross profit will be the 30%, and our selling price will be 100%. Guys, they've indicated to us that the gross profit percentage is 30% on sales, therefore 30 on the 100. Therefore, to calculate our unrealized profit, it will be the 62,000 times 30%. This will be 18,600. The vehicle had an estimated remaining useful life of 4 years on 1 November 20.12, which corresponds to the wear and tear allowance claimable as a taxation deduction. Important, guys, the tax allowance and the depreciation is equal, therefore there will not be any deferred taxes realized relating to this asset. Now we need to prepare the pro forma journal entries for the 20.13 financial year. Now, guys, I've included a timeline to ensure that I always understand the information provided. First, we've identified that we have purchased this asset on 1 November 20.12, and this is the subsidiary that sold to the parent. Remember, guys, when we consolidate, we add 100% parent plus 100% subsidiary. Our year end is 31 December 20.12 and then 31 December 20.13. We need to prepare the pro forma journal entries for 31 December 20.13. Now, guys, where do we start? First, you need to ensure that you understand, guys, that when we look at 31 December 20.13, that we will receive a clean trial balance when we need to prepare our consolidation process. Therefore, guys, in this clean trial balance, we have not yet recognized the 20.12 pro forma journal entries. Now, to be able to perform the pro forma journal entries for 20.13, we need to go back to our transaction date on 1 November 20.12. Now, guys, I'm going to use this to explain to you the journals of 20.13. Therefore, you do not have to do the 2012 journals. I'm going to use this to explain the 20.13 journals. Now, remember, we have recognized that there is an unrealized profit of 18,600 included. Now, in the separate records, guys, important, in the separate records of our subsidiary will debit the debtor, which will be the parent, and this will be in our statement of financial position with an amount of 62,000. Guys, if they've indicated to you that they've paid cash, remember, then you will have to debit your bank account. And then we will have to credit our asset, the carrying amount. Remember, you will actually have to use your cost and your accumulated depreciation. And this will be in our subsidiaries record. Why? Because we now need to take out the asset in our subsidiary. And this will be with the 43,400. And then we will recognize an other income, which is the gain, the profit on the sale. In our profit and loss, and this is an amount of 18,600. Then guys, now for us to be able to perform our pro forma journal entries, we now need to perform the group journals. Therefore guys, what happens in the group? Remember that the parent has purchased this asset, therefore the parent paid for this asset 18,600 additional. Therefore, there's a profit being realized in the separate records of the subsidiary, but in the group, there's no profit. Okay, guys, this is the same group. Therefore, there will be no profit between these two entities when we add this together. Therefore, guys, in our group, we will now have to take out this other income. We will have to take this out. Very important. And to take it out, we will then debit our other income. Remember, we are still busy with 2012. And this will be in our profit and loss of 18,600. And credit our data in our statement of financial position with the 18,600. And as always, guys, you need to remember the tax implication. In this scenario, we debit our other income. Therefore, our income decreases. If our income decreases, our income tax will decrease. Our income tax is an expense account. Therefore, an expense account increase on the debit side and decrease on the credit side. Therefore, we will have to credit our income tax. Remember, no abbreviations in a test or in an exam, guys. Profit and loss. And we will have to debit our deferred tax in our statement of financial position. And this is an amount of 5208. Now you need to identify for the year end 31 December 20.12 that our parent has depreciated this asset. Therefore, again, guys, in the separate records of our parent, the parent shall debit depreciation and credit accumulated depreciation. Now, what is the value, guys? Remember now that the parent has recognized this asset at 62,000. But the value should only be the 43,400. Therefore, there is this additional depreciation that the parent has recognized on the 18,600. Therefore, guys, this will be for a period of 2 months, and this will be the 18,600 times 4 years times 2 over 12, and this will be an amount of 775. Now, guys, then you need to remember that there is tax that you need to account for. In this scenario, our depreciation increase. This is an expense. If the expense increase, our profit decrease. Therefore, our income tax decrease. And we will have to credit the income tax in our profit and loss. And then debit our deferred tax in our statement of financial position. And this will be the 775 times 28%. And this is 217. Now, what happens in our group records, guys? We now need to take this out. Therefore, we will have to reverse this. Now, guys, ensure that you understand why do we take this out. This is depreciation recognized by our parent on the unrealized profit. Therefore, it's profit, but it's not realized. We can't realize this in our group. Why not? Guys, because we add 100% of our parent plus 100% of our subsidiary. So technically, at the end of the day, we are now one company. So we're selling to ourselves. Okay. So therefore, we need to take this out and we will reverse these journal entries. We will now debit our accumulated depreciation in our statement of financial position. We will credit our depreciation in our profit and loss, the 775. Guys, you can combine these journal entries if you want to. And then we can debit our deferred tax, statement of financial position, and we credit our income tax in our profit and loss with it 217,217. Okay, guys, so to summarize this, there is technically 3 steps or 3 things that you need to remember. The first will be the initial transaction to take out the unrealized profit. The second one will be the depreciation, and the third one will be your tax that you need to take into account. Now, guys, we are looking at 31 December 2013. Now, a very important principle that I want to ensure that you understand. When we prepare the financials in an actual situation, guys, and remember, I'm talking out of my experience at Telkom for 3 years. I've been part of the consolidation team there. Now, after the audit, we will receive all of the separate financials of the entities. It's important that you understand that our prior pro forma journal entries have not yet been taken into account. Therefore, guys, important, when we receive these separate sets of trial balances, we have not taken into account the group journals. And this is the reason why you will have to include your elimination journal entry every year, because we receive a clean set. Therefore, guys, if we look at our pro forma journal entries for 20.12, these journal entries has not yet been recognized in 20.13. Now we need to recognize them in 20.13. But how do we do this? So do you agree with me if I indicate to you that at the end of 20.12, the profit and loss recognized will move to your retained earnings in your statement of changes in equity? Yes? Okay, so if this happens and you look at your journal entries, do you agree with me that all of the journal entries recognized in your profit and loss, if you want to recognize them in 20.13, you will now have to recognize them in your retained earnings? Okay, so let's have a look at this. Remember, we need to do the group journals. Therefore, let's identify all of the transactions that's recognized in our profit and loss. Remember, only for our group, guys. Therefore, our journal entry will now be to debit our retained earnings in our statement of changes in equity with the 18,600. Why? In the prior year, we've recognized this in our other income that will be recognized in our profit and loss. And then we will still debit our data, as this will be an amount at year end in our statement of financial position, the 18,600. We need to then debit our deferred tax, statement of financial position. Now, guys, I'm not going to go through the discussion on why debits and credits. That's why I've discussed this in our 20.12 pro forma journal entries. I'm only discussing the fact that we are technically now recognizing everything that we've previously recognized in our profit and loss in our retained earnings. And we will credit our retained earnings in our statement of changes in equity, guys. Remember, with the 5208 and our group depreciation, we will debit our accumulated depreciation in our statement of financial position, and we will credit our retained earnings, remember, in our statement of changes in equity with a 775, and we will debit our deferred tax and credit our retained earnings in our statement of changes in equity with a 217. Now guys, very important. If we perform our 31 December 2013 financials, that our parent will recognize depreciation on the unrealized portion. Therefore, we now need to take this out when we recognize our group transactions. And this will be the 18,600 divided by 4, and this will be 4650, and remember the tax at 28%, 1302. Now let's first discuss what will the journal entry be in the separate records of our parent. Remember, this is not required, however, I'm using this to explain to you the journal entry in the group. Our parent will debit depreciation, credit accumulated depreciation with a 4650, and will debit deferred tax and credit income tax. Why credit income tax? Remember, our expenses increase. This will result in an decrease in our profit and therefore a decrease in our income tax with an amount of 1302. Now, in our group, we need to reverse this journal entry. Therefore, we will debit our accumulated depreciation in our statement of financial position. We will credit our depreciation in our profit and loss with a 4650, and we will reverse our tax journal, debit our income tax, and credit our deferred tax, 1302. Okay guys, so that is our pro forma journal entries. Now guys, let's quickly discuss the fact that these journal entries will have an effect on the analysis of owner's equity of our subsidiary. Now guys, remember our analysis is divided at the at acquisition portion, the since acquisition until beginning of the year, and then for the current year. Now we need to identify the amounts that will be recognized in the since acquisition period in our retained earnings. Now when we have a look at our journal entries, it will be to debit the retained earnings, therefore decrease. Okay, and then this 5208 amount, the 775 and the 217. Therefore guys, the net effect that shall be recognized in our retained earnings will be an amount of 12834. And then the net effect that shall be recognized in our profit or loss for the year will be the 4650 minus the 1302. And this is a credit. Therefore, we will have to add this to our profit and loss, and this will be 3348. Our retained earnings is a debit, therefore we will have to deduct this from our retained earnings. Now guys, I want to summarize. Important that you understand in whose records are you busy with. Is there depreciation that you need to reverse? Are you busy with your pro forma journal entries for 20.12, the current year, or for 20.13? This is important to identify if you need to include your retained earnings journals.